It is very hard to make predictions about traditional finance, about where stocks are going, where precious metals are going, where maybe commodities are going, and that's because there's a lot of professional investors in this. There's hedge funds, there's banks with a lot of resources, there's the smartest math PhDs working for various companies. And then we try to beat that competition. We try to figure out what are really the lows and the highs in the market. Traditional finance is much harder to beat than crypto. However, it's still important to have a look every now and then at traditional finance metrics because there is a spillover effect. If traditional finance was to suddenly crash again, as for example during COVID, then this does have an effect on crypto as well. During COVID, when stocks crashed, a few days afterwards, crypto, and Bitcoin included, crashed as well. Let's have a look at a few metrics that might be relevant right now. For example, this here. This is the Federal Reserve balance sheet. When this is going down, we've got monetary tightening. That means the Federal Reserve is releasing assets into the market, increasing the supply of liquid assets, potentially depressing the price. Now, the tightening has stopped since beginning of the year. The federal balance sheet is not going down anymore. That's positive for risk on assets. That's positive for stocks. Have a look at this. In green, we see the US interest rate. So it's the target rate by the Federal Reserve. In blue, we see the inflation rate. We can see when inflation rates come down, then the interest rate follows. When the inflation rate comes up, then the interest rate follows. When the interest rate is higher relative to the inflation rate, then we've got real returns for government bonds. So if you then get, say, 10% on your bond and the inflation rate is only 3%, you are making 7% in real purchasing power year over year just by being completely risk off, just by buying government bonds. When, however, the interest rate is below the inflation rate, then people get forced to buy risk on assets. Then they are forced to buy stocks and push up the valuations. Currently, interest rates tend to trend down. The inflation rate is below the interest rates. But there's something interesting here. If inflation doesn't further decline, the Federal Reserve will have a hard time justifying to further reduce the rate. And there is an inverse correlation here. Whenever interest rates come down, this is good for risk on assets because that means we have to discount future cash flows less. So we value any investment for that matter by its future cash flows. Or cash flow producing assets, so that might be property, that might be stocks, that might be regular businesses. We try to estimate their future cash flows and then we bring them to the present. We calculate the present value of those future cash flows. Now we have to discount the cash flows that are far out in the future. When we've got cash flows that are maybe 10 years away from here, 20 years away from here, 30 years away from here, then of course the cash flows that are 30 years away from here are worth much less to us than the cash flows that happen just a few days from now. That's because of the time preference of money, right? We want to have the money rather today than in 30 years, but that's also because of inflation. And so when interest rates come down, this means we have to discount the future cash flows less. When interest rates come up, we have to discount them more because we get all of that cash flow already risk-free. Strong discounting means less present value, means a smaller price for all investment. That's why we've got this inverse correlation between investment prices and interest rates. And so if we don't see a further decline of interest rates because the inflation rate isn't coming down further, then this might be a shock for the system because market participants still anticipate further reductions of the target rate going forward. But the Federal Reserve has a harder and harder time to decrease the interest rate. Let's have a look at the real interest rate. So let's calculate the delta between the two. That's over here. The Fed interest rate minus the officially measured inflation rate. So that's the real interest. It fluctuates over time. The dotted line here, that's the long-term average. So on average, the real return on government bonds, if we just take official inflation numbers, it's at 1.1%. So we are already very close to what the Federal Reserve considers a comfortable equilibrium. Long term, we were exactly at the current level. Reducing the interest rate further would bring us further down. And that's below the equilibrium, and the Federal Reserve can't do that forever. I'm actually quite surprised that still many people look at numbers like this, the US GDP. The US GDP is measured in US dollars, but the number of dollars that are floating around is expanding over time. And so really, how can we compare a US GDP of today with a US GDP, say 60 years ago, when the kind of dollars that are floating around today are worth much less compared to the dollars in the 1960s? Really, a fair comparison would be to look at the GDP in constant dollars. This is now the US GDP relative to the US money supply. And if you feel that you've got it harder compared to your parents, you're probably not that wrong. The US GDP relative to the money supply in the last 30 years declined by roughly 38%. And this is something I believe not many people have on their radar. Most people don't measure the GDP in that way. But if the GDP is shrinking relative to the money supply, of course it gets harder and harder to buy that house, to buy the land, to do something of substance, to buy things that don't become cheaper and cheaper over time. Just keeping up with monetary debasement is getting harder and harder for the entire economy, but especially for the average Joe, because capital concentrates over time. The rich have more and more money, the poor have less and less. And so the US debt to GDP is at all-time highs. And the big question is, will there be enough willingness to turn this around? Will the rich get taxed enough? Will expenses decline enough? This is the very first time we have seen such an increase in the US GDP without a major geopolitical conflict, right? This year was World War II. At the same time, valuations for stocks are incredibly high. And that's also another problem, right? If everything is so risky right now, if the economy in constant dollars is actually not going up, but at the same time, the price to earnings ratios long term continue to rise, then how will this end? This here was the Great Depression. That put strain on all economies worldwide and definitely didn't help Germany either, and was potentially a contributor to the development of World War II. Here we've got the dot-com crisis, here we've got the global financial crisis, and we are now very close to all-time highs in price to earnings ratios for stocks. Fundamentally, when we buy a stock, we are simply buying the future earnings of the company. So a high price to earnings ratio simply means we are now paying much more for those future earnings. The market is anticipating much higher earnings growth in the future. Will that happen though? That's the big question. That's not very clear in my opinion. Have a look at the S&P 500 relative to the money supply. That's also very close to an all-time high. What I find interesting is how this also oscillates around a potential equilibrium. Or in other words, the vast majority of stock returns simply comes from monetary debasement. The S&P 500 is mainly going up over time because the US dollar is devaluing, because there's more and more US dollars getting created. The dotted line that we see over here, that's the average ratio of the S&P 500 to the US money supply. And if you were to see an implosion of, say, the artificial intelligence bubble right now, something similar to what we have seen during .com, right? Artificial intelligence is useful, as was the internet back in the day, but there might be temporary overinvestment, and maybe the hype dies down. And maybe the S&P 500 goes back to its equilibrium. Maybe it falls by 48% from here. Maybe the potential risk versus reward is not that much worth it. All of this appreciation that we have seen since 2009, since the creation of Bitcoin, right? Bitcoin was created over here roughly at the beginning of 2009. All of that expansion was due to the price to earnings ratio going up. It was not the earnings themselves going up that much. This year is roughly a 2.5x in the PE ratio. We also have roughly a 2.5 to 3.5x in the S&P 500 gains relative to the US money supply. And that's what makes things so troubling. If stocks were to suddenly crash, that would bring down crypto as well. We've already seen this during COVID, right? When the COVID crash hit, we saw first the stocks selling off, and just a few days afterwards, Bitcoin reacted to that as well with leverage. So the Nasdaq 100 dropped by roughly 30%. Bitcoin, however, dropped by 50 to 60%. Now imagine what a 50% drop in stocks would mean to Bitcoin. Probably a drop that's more than that, right? Maybe a drop of of 70, 80, or even 90%. I'm simply pointing out the potential risks. I'm not saying that this will definitely happen. But have a look at this here. This is now the Nasdaq 100 relative to the S&P 500. This rectangle here simply shows the .com boom and subsequent bust. In very long term, the Nasdaq 100 does outperform the regular stock market. That's partially due to the avoidance of dividend payments by many tech companies. The S&P 500 on average pays out 1.1% of dividends per year. The Nasdaq 100 pays out much, much less. And when capital is retained, it can continue to compound and it can continue to get reflected in the price development. And in the end, both the S&P 500 and the Nasdaq 100 are price indices, not performance indices. There's already first signs, as in Nvidia losing some confidence in OpenAI, potentially not investing as much as originally anticipated. Feel free to check out this video here by Wall Street Millennial. And then there's the problem with the humanoid robots. Will the humanoid robots really fulfill all the promises, all the hopes, and will they justify the heavy investments? It's yet to be seen. Maybe both AI and humanoid robots are currently overhyped. And what would that then make to the valuations of technology companies, especially companies that are heavily in those sectors now? Some people say that a potential rescue from all of this is buying gold. But I'm not so sure. This is now gold relative to the US money supply. Again, we're just looking at relative valuations. How would gold be priced if there was a constant US dollar supply? The dotted line is the average ratio of the gold price relative to the monetary base. So we are currently roughly 90% above that equilibrium. But it goes so far to say that this dotted line might actually be too optimistic, because what this implies is that gold will keep pace with the monetary expansion. The monetary base expands by roughly 6.8% per annum, but gold's supply also expands year over year by roughly 2%. So really, the gold price should be losing against this constant ratio by roughly 2% per annum. And that's then what this line here indicates. This point was in 1980. We are now in 2026. We have 47 years of data. If we compound a loss of 2% over that time period, we are left with 39% of purchasing power, or in other words, a 61% drop. And if you compare those two tops, we are very close to that 61%. So really, if we were to compare not the gold price versus the monetary base, but the gold market cap relative to the monetary base, then those 2 points in time would align quite perfectly. And so gold is probably not the best escape out of this either. It was a very nice investment 1 or 2 years ago when we started buying, but now it's extremely expensive. Really, I think it's not that bad to simply try to preserve purchasing power, to not get completely crushed in the upcoming crash. If we can, with our diversified portfolio, get the 6.8% return measured in US dollars, and that's how much the monetary base is expanding over time. If we can keep that growth during the current times, I think we are doing okay. Opportunities are to be found where nobody else is looking. It's by betting on falling prices. That's what we currently do here. This is the Bitcoin moving average trading vault. Here is the same for Ethereum. And so if you don't believe in the AI hype, if you don't believe in the robotics hype, and maybe it makes sense to do things like shorting stocks like Tesla. I'm considering to open that position again. Tesla is very close to its all-time high relative to the Nasdaq 100, and it already sees first signs of weaknesses, and it's high in its trading range, and it could easily underperform the rest of the market by 65%. If, of course, the momentum turns bearish. If suddenly people stop all of their positive bullishness, if suddenly there are some cracks in the system, Tesla could be falling much more than the average stock. Again, it's very hard, of course, to beat the general stock market. And many people have lost their shirt trying to short Tesla. But I think currently it makes sense to just have a little bit of a diversifier in a portfolio. Instead of just trying to bet on further increasing valuations, it might make sense to flip this around, to be hedged to a degree at least. The fundamental problem is that Ethereum is the driver of the entire altcoin market. When Ethereum is going down, then the altcoins come down with it. And yes, you can try to pick the 1, 2, or 3 winners in a market like this, but I do not recommend that. Just have a look at how much Ethereum, so that's the blue line, is correlated with the others market cap. So the altcoins that are not in the top 10. The two assets tend to move in the same direction at the same time. There is strong correlation. And so timing the macro picture is incredibly important, not just for Ethereum, but also for the altcoins. And the way I time this is with best moving averages. We want to bet on rising prices whenever we are above the moving average. We want to bet on falling prices whenever we are below the moving average. I'm doing this for Ethereum. I'm also doing this for Bitcoin. People have really forgotten how volatile Ethereum can be. And this is what makes it such a good candidate for trend following strategies like this. From top to bottom, ETH at one point has lost 94% of its value. You put in $10,000, you get back $600. But that also means when we buy low and sell high, we can have multiple thousands of percent in return. Market timing is even more important for Ethereum than it is for Bitcoin. But then of course there's the question, what moving average should we use for such a strategy? Should it be the 200-day? Should it be the 150-day? Should it be, say, the 100-day? What kind of moving average duration works the best for Ethereum? I have run the numbers, I have run the simulation. 33 days is the answer. So here at the x-axis, we've got the duration of the moving average. 33 days gives the best annualized return. And you can simply use that moving average to sell whenever we are below. So you don't even have to bet on falling prices. You can simply just get in cash and then buy back whenever we are above. That is this chart over here. But if you're also betting on falling prices, then we turn from this performance to this performance. This here is a logarithmic chart, right? So this back-tested performance is roughly 100x just buying and holding ETH, while Ethereum just went sideways, following the trends, tended to outperform quite nicely. We can then also optimize leverage, both for the long side and the short side. And then we're moving from this outperformance to this. And that's what I find really attractive. I like to put my money in strategies like this. Yes, we don't know how well they work in the future, but at least those kind of trading rules worked very well in the past. And it's no gut feel, it's no random guessing. Simply just using things that statistically worked well. That's what I personally do. So there's a Bitcoin trend following strategy. There is an Ethereum trend following strategy. The backtested result for the Ethereum trend follower is higher than for the Bitcoin trend follower. It's 210% yearly outperformance. So we more than triple our ETH stack every year. But again, this is backtested. We don't know if we're getting the same performance going forward. But at least if it's going to be outperformance, that's fine with me. The ETH trend following is set up on a decentralized finance protocol called Gravity. Gravity is the 5th largest perpetual futures exchange. Its trading volume is rising. Its capital on the platform is rising. And across all the trading strategies that are listed on the platform, we are by far the best performer. Everyone else is suffering and the gains go to the few. Here's the development over time, by the way. And so I like those strategies backed by math much more than just trying to follow the news, trying to figure out what's going on. An approach that has worked for years with massive outperformance in the past has a good likelihood, I believe, to continue to work in the future. So I put my money in this as well. If you want to do the same, then feel free to check out the premium membership. It's currently $125 per month. You can simply sign up for one single month, deploy all your capital over here, and then unsubscribe again. You do not have to be subscribed all the time just to deploy your capital. But of course, I'd appreciate if you also check out the tutorial videos. This is where I explain how I manage my money and how I outperform Bitcoin and Ethereum over the long term. If you got some value out of this video, feel free to give this a like. It helps the channel grow. Feel free to check out Premium. Link pops up here on the screen. Thanks for watching. See you next time. Cheers.